Because beneath the headlines, a silent power shift is unfolding. Between East and West, between paper wealth and real assets, you're about to see why $80 silver is just the beginning. Why mining stocks, once forgotten, are now ground zero in the next capital war. And why one hidden policy move could detonate the entire global metals market. The clues were always there, but no one paid attention. Until now. This is your final window to understand what's really coming next. Before the floodgates open, welcome to CSC Alert, where we connect the financial dots they don't want you to see. If you're over 50, you've seen booms and busts, but have you ever seen a setup this obvious, yet this ignored? Click that subscribe button like you're locking in your pension before the storm, and tell us in the comments, where in the world are you watching from today? In 2025, something strange happened in the world of silver, gold, and mining stocks. Prices moved up, steadily, powerfully, but quietly. There were no loud headlines, no breaking news segments, no media frenzy. Yet those who were paying attention saw it clearly. Something fundamental had changed. Silver began the year at around $30 an ounce. It hovered near that level for months, January, February, even into May. Then, in the second half of the year, it started climbing. Slowly at first, then more sharply. By December, silver had crossed $80 in some physical markets, while COMEX contracts struggled to keep pace. Gold followed a similar path. Mining stocks, after years of underperformance and investor neglect, started moving too. Not with the speed of a meme stock, but with the strength of something real, backed by supply, demand, and geopolitics. To the average observer, it looked like a standard commodity rally. But to those who studied macroeconomics, industrial policy, and global trade, this was no ordinary cycle. This was a signal. Behind the scenes, the structure of the global economy had quietly shifted, and 2025 was the year the consequences began to show. Lior Gantz, founder of Wealth Research Group, was one of the few analysts who saw it coming. He described 2025 not as a breakout year, but as a setup year. A year where signals began to replace noise, a year where metals began reacting not to media narratives, but to the reshaping of global power. He pointed back to November 2016, the first Trump presidency, as the moment the post-globalization framework began to erode. That was the turning point when U.S. leadership began questioning the old model of open borders, free trade, and multinational dependence. But it wasn't until 2025 that the financial markets truly started pricing in this new era. It began with a date, April 2nd, 2025. Dubbed Liberation Day by insiders, it marked the day the U.S. administration enacted sweeping tariffs on foreign goods, starting with steel, copper, and aluminum. Most expected political theater. Instead, markets plunged. Investors had heard these threats before, but this time, the policies were real, not symbolic, not watered down. For silver, this was the beginning of a chain reaction. When tariffs go up, the cost of imported industrial goods rises, and when those goods are crucial to manufacturing and energy infrastructure, like silver is, prices adjust fast. By April 7th, silver had reached its yearly low. From that point on, it only moved upward. But tariffs were only part of the picture. In August, the U.S. doubled down, expanding the tariffs and adding more pressure to critical material imports. The message was clear. If companies wanted access to the U.S. consumer market, they had to pay a premium. Meanwhile, across the Pacific, China made its own move. In October, Chinese authorities issued formal letters to several foreign governments. Rare earth exports would be restricted. The world's largest processor of critical minerals was drawing a red line. It was a soft embargo, but one with sharp teeth. Then came the surprise. Shortly after the rare earth letter, silver was added to the restriction list. Without warning, one of the most globally used industrial metals became a geopolitical tool. That's when markets began to shift, not just in price, but in understanding. Silver was no longer just a commodity. It had become a strategic asset. For decades, silver had been treated as a leftover metal, abundant, cheap, and often mined only as a byproduct of other operations. It had lost its monetary status. Governments stopped stockpiling it. Investors ignored it. But in 2025, that changed. Industries couldn't ignore the reality. Silver was essential. It powered solar panels, electric vehicles, industrial circuits, and AI server components. It was irreplaceable in many processes. And unlike oil or copper, it wasn't easy to ramp up supply. This was not a retail-driven rally. This was industrial panic. Manufacturers realized that without silver, production would slow or stop. And when Chinese export controls mixed with U.S. tariffs, the result was predictable. Higher prices, regional shortages, and a scramble to secure forward supply. Mining stocks reacted late, but once they did, they began attracting attention from institutional players. Still, few fund managers understood what was happening beneath the surface. Most were still watching the dollar index or analyzing CPI data, missing the geopolitical transformation driving silver HOS surge. Gantz described it as the end of the fake price era. For decades, silver prices had been artificially low. set by futures markets that had no connection to physical supply. But by the end of 2025, those illusions were cracking. The world was fragmenting. The price of silver in New York was no longer the same as in Shanghai or Dubai. Arbitrage had failed. The market was waking up to the reality that the old pricing mechanisms no longer worked. This is what made 2025 so important. It wasn't just the year silver went up. It was the year the system behind silver began to break apart. And that, more than any chart or technical pattern, was the signal serious investors couldn't afford to ignore. Because if 2025 was the warning, 2026 is the reckoning. By early 2026, it had become impossible to ignore a silent truth in the global economy. The world was no longer built on free trade. It was built on access, and access was now political. For decades, the promise of globalization was that goods would flow smoothly across borders, supply chains would remain efficient, and prices would stay low. That promise is now broken. Silver, gold, and other critical minerals were no longer just commodities. They had become weapons in a much larger power struggle between nations. And while media headlines focused on inflation or interest rates, a deeper economic shift was unfolding quietly across boardrooms, ports, and processing plants. China and the United States, the two largest economic forces on the planet, were rewriting the rules of trade. And in the middle of this new battlefield sat the metals that make modern life possible. For years, China built a dominance not just in mining, but in refining, processing, and export control. Rare earths, lithium, graphite, and now silver, these were no longer passive materials. They were levers of influence. China had the rare ability to do what few others could: control the choke points. In October 2025, when Beijing issued formal guidance restricting the export of rare earths, it wasn't a surprise. But when silver appeared on that same list weeks later, it signaled something far more serious. Silver isn't rare in the geological sense, but refined, high-purity, industry-ready silver, the kind used in solar panels, electric vehicles, and semiconductors, is difficult to scale and even harder to replace. And China knew it. They weren't banning silver exports. They were licensing them, creating a political filter on who received shipments and when. The message was clear. If your nation's policies are unfriendly to China, your industries may face a delay, a quota, or a redirection of cargo elsewhere. It wasn't a blunt weapon. It was a scalpel. Quiet, precise, and effective. Meanwhile, in the United States, the strategy looked very different but served the same purpose: control of access. The April 2025 Liberation Day tariffs were not only a political stunt, they were part of a larger framework designed to reshape America's industrial base. By taxing imports of copper, steel, and aluminum, the administration sent a message: build here or pay more to sell here. August 2025 took it further. A 50% tariff on industrial metals shocked even the most seasoned investors. The idea, according to analysts, was to recreate an internal supply chain, not just for economic strength, but for national security. The U.S. had learned during COVID and the semiconductor shortage that relying on overseas materials was a vulnerability. The tariffs were a hard correction, a way of forcing reshoring, even if it meant higher prices. And then came the mirror effect. Just as the U.S. was using its consumer market as leverage, China was using its control over raw material processing. One side blocked the door, the other blocked the tools. Silver was caught in between. What emerged was a regionalization of the metal markets. In the past, silver prices were mostly driven by futures markets in New York, COMEX, or London, LBMA. But by late 2025, those benchmarks were being challenged by real-world constraints. In Shanghai, physical silver sold for a premium of $5 to $8 over COMEX futures. In Dubai, wholesalers complained of 6 to 12-week delivery delays. In India, smelters were quietly increasing storage levels and offering local refineries above market rates to secure guaranteed supply. This price divergence wasn't a short-term dislocation. It was a signal that silver's geopolitical risk premium had arrived. The same bar of silver now had different values depending on where it was and who controlled its flow. For business owners, manufacturers, and investors, this shift created uncertainty. But for governments and institutions with foresight, it created urgency. By late 2025, the Pentagon had announced an investment stake in a new $7.4 billion silver and critical metals smelter in Tennessee. Quietly backed by the Department of Defense and the Department of Commerce, this was the first major non-ferrous metals facility built on U.S. soil in decades. Its purpose? To reduce dependency on Chinese and Latin American refining. The message couldn't have been clearer. Silver is now a national security asset. At the same time, China's response was to tighten its grip. Only 44 companies were licensed to export refined silver under the new 2026 regulations, and none of them could exceed their quota without a formal government waiver. This created bottlenecks even for friendly nations. The result, a fragile, tense global silver market. held together by politics, not contracts. What began as a policy tool, tariffs, licenses, incentives, had become a supply chain stranglehold. And as industries woke up to the reality that silver was no longer freely available on the open market, prices started to reflect that truth. This wasn't a speculative rally. It was a repricing of trust. Trust in global supply chains, trust in diplomatic stability, trust in the illusion that resources could always be bought, regardless of who held them. Those days were over, and for any serious investor, entrepreneur, or business strategist, the message was now clear. Silver is not just a metal. It is a mirror reflecting the real balance of global power. And in 2026, that balance is starting to shift in ways few are prepared for. For most of modern financial history, silver lived in the shadow of gold. It was once money, then slowly lost that role. Governments stopped holding it. Central banks ignored it. Investors treated it as a secondary metal, volatile, unreliable, and unimportant. By the early 1990s, silver had effectively been demonetized. When the Soviet Union collapsed and the Cold War ended, the world entered a period of relative stability. Military stockpiles were reduced, industrial efficiency improved, silver flooded the market. Prices fell so low that mining companies stopped building projects around it. Silver did not disappear, but it was downgraded. It became a byproduct. Most silver produced after 1993 came not from dedicated silver mines, but from copper, lead, and zinc operations. If those metals were profitable, silver came along for the ride. If they were not, silver supply declined without warning. This structure worked when silver was cheap and plentiful. It does not work anymore. By the early 2020s, a quiet imbalance had begun to form. Global silver demand was rising, but supply was not. Industrial usage expanded into areas no one had planned for. Solar panels, electric vehicles, medical equipment, advanced electronics, and data centers all relied on silver as its unique property. It is the best electrical conductor on Earth. No substitute matched its efficiency. At the same time, recycling failed to keep up. Silver is often used in tiny amounts spread across circuits, films, and coatings. Once used, much of it is lost permanently. Unlike gold, it does not always return to the market. By 2024, the world had entered its 6th consecutive year of silver deficits. More silver was being consumed than mined. The difference came from above-ground stockpiles, a silent drawdown that few noticed, until prices began to rise. This is where the silver paradox emerged. On one hand, silver was still treated by financial markets as abundant and cheap. Futures markets assumed supply would respond to price increases, as it does with oil or copper. On the other hand, in the real world, silver supply was rigid. New silver mines take years, often a decade or more, to permit, finance, and build. Environmental regulations, community opposition, and political uncertainty slowed every step. And because silver was a byproduct, higher prices did not automatically create new production. The market assumed flexibility. Reality offered none. This disconnect became impossible to ignore in 2025. Manufacturers began asking uncomfortable questions. Chief financial officers started modeling scenarios they had never considered before. At what price does silver become too expensive to use? At what price does substitution become viable? At what price does recycling suddenly make economic sense? The answers were unsettling. Most industrial uses of silver remain economical well above $100 an ounce. In some cases, above $150, substitutes reduce performance. Recycling infrastructure requires time, capital, and policy support. In short, demand was sticky and supply was fragile. This is what made 2285 fundamentally different from previous silver bull markets. In 1980, silver surged because two investors tried to corner the market. In 2011, it rose due to monetary panic and retail speculation. Both rallies collapsed once leverage was removed. But the current cycle is not driven by leverage. It is driven by necessity. Industrial buyers do not speculate. They secure supply. This subtle shift explains why traditional market tools failed to predict silver's rise. Momentum indicators, technical patterns, and sentiment surveys missed the bigger picture. Silver was no longer behaving like a financial asset. It was behaving like infrastructure. Then came the wild card, remonetization. For decades, no government had seriously considered silver as a monetary asset. Gold held that role alone. But by late 2025, small policy changes hinted at something new. In India, banks began accepting silver as collateral for agricultural loans in select regions. It was not national policy, but it was precedent. India has over 1.4 billion people. Silver is culturally trusted. It is affordable, and it is already held widely across rural communities. Even a partial monetization, limited to pensions, loans, or savings programs, could create massive new demand. It does not require a global decision. It requires one government. History shows that monetary change rarely begins at the center. It begins at the edges. A regional government, a developing nation, a small policy shift that becomes permanent. If silver re-enters the monetary system, even modestly, the market structure changes overnight. This possibility forced serious analysts to revisit price assumptions. Lior Gantz was one of them. His conclusion was not sensational, but it was direct. At around $120 per ounce, silver begins to reach its economic balance point. At that level, some industrial substitutions make sense. Recycling becomes more viable. But demand does not collapse. A $120 silver price does not require gold to explode. Even at $5,000 gold, the gold-to-silver ratio would still be near 40.1, well within historical norms. In other words, silver does not need a crisis to rise further. It only needs continuity. Continuity of deficits, continuity of industrial demand, continuity of geopolitical tension. And all three are already in place. By the end of 2025, the silver market had crossed a psychological line. It was no longer ignored, but it was not yet fully understood. That gap between recognition and realization is where the greatest risk and opportunity now sits, because when markets finally accept what silver has become, prices do not adjust slowly, they adjust all at once. And that realization sets the stage for the next piece of the puzzle, the one most investors still underestimate: precious metal mining stocks. As silver prices surged in the second half of 2025, another trend quietly began to unfold, less visible than the metal itself, but no less important. It started in the financial markets, deep within a sector most investors had long dismissed as irrelevant: precious metal mining stocks. These companies, many of them small, remote, and capital-starved, had been forgotten for over a decade. Even as silver demand surged, investor capital flowed elsewhere, toward technology, AI, and passive ETFs. Mining was viewed as a relic of the past, slow-moving, high-risk, and politically complicated. But by late 2025, that sentiment had started to crack. Wall Street wasn't rushing into the sector, but it was watching. And when institutional capital watches a thin, underweighted sector with global exposure, the outcome is rarely linear. The silver bull market had changed the landscape. Prices were rising not because of hype or emotion, but because of structural constraints: geopolitical supply friction, industrial necessity, and a broken pricing mechanism. This meant the rally wasn't speculative. It was foundational. Yet mining equities lagged behind. In past commodity cycles, mining stocks would often move first. Traders would front-run the metals, anticipating the rally. But in 2025, this didn't happen. Part of the reason was trust. For years, mining companies had underperformed, overpromised, and disappointed. They were capital inefficient, vulnerable to regulation, and hard to scale. Fund managers had moved on. But in 2026, that indifference may no longer be an option. The issue is scale. The combined market capitalization of all silver mining stocks globally is tiny. In some charts, it barely registers. Side-by-side comparisons with technology giants like Nvidia or Amazon reveal the disconnect. The silver mining sector is smaller than a single large-cap stock. This creates a math problem. When even a small percentage of institutional capital begins to reallocate into mining, whether for diversification, inflation hedging, or portfolio rebalancing, the impact is outsized. There simply isn't enough float, liquidity, or share availability to absorb it quietly. This is what analysts call the capital flood effect. A flood not because of sheer dollar volume, but because the pool is so shallow. Two events are now driving this transition from observation to action. First, performance. Gold and silver both outperformed tech stocks in the second half of 2025 on a risk-adjusted basis. For institutional money, that sets off an internal alarm. No fund manager wants to finish the year underperforming because they ignored a rising asset class. In a world where passive index funds dominate, active managers must differentiate, and mining is becoming a rare opportunity to do so. Second, regulation. The Trump administration's accelerated permitting push, combined with new incentives for domestic resource development, is changing the regulatory environment. Mining is no longer a bureaucratic trap. It's being reframed as a strategic necessity. Junior explorers, once starved of capital, are suddenly being approached by majors and mid-tiers eager to secure development projects. The traditional wait and buy them cheap later model no longer works. If a competitor acquires the asset first, the opportunity is gone. The pressure to act early is rising. This is leading to a new dynamic: forced consolidation. Senior miners are sitting on record-free cash flow thanks to high metal prices and lower than expected energy costs. With oil prices stable and the US dollar weakening, their margins are expanding. But exploration pipelines are thin. Years of underinvestment have left most senior producers without a strong next-generation portfolio. If they don't move now, they may not have the resources to meet demand in 5 years. As a result, acquisitions are accelerating. Companies that were previously ignored due to location, size, or risk profile are now being reevaluated. Strategic partnerships, royalty agreements, and full buyouts are all on the table. What matters now is scale, jurisdictional safety, and timeline to production. Investors who understand this cycle are positioning not based on current earnings, but on who will be acquired first. This creates both opportunity and risk. On one hand, early investors in quality junior mining companies could see significant returns as institutional capital rotates into the sector and M&A activity intensifies. On the other hand, the sector remains volatile, operationally complex, and uneven. Not every company will survive. The challenge for investors is separating speculative noise from strategic value. The window to do so is closing quickly, because once capital moves from the sidelines to the field, it doesn't trickle, it surges. There's another layer to this story, one even more overlooked. In 2026, mining stocks are not just a play on rising metal prices, they are also becoming a proxy for access. Governments cannot easily build mines. They can regulate, finance, and incentivize, but ultimately, they must partner with companies that already control the land, permits, and technology. This means that mining companies, particularly those with access to strategic jurisdictions like North America, Australia, and select Latin American nations, are becoming gatekeepers. They don't just produce metal. They control access to the industrial future. EV batteries, solar panels, semiconductors, weapon systems, infrastructure, all depend on the raw inputs that these companies bring out of the ground. As the global economy fractures into competing blocks, access becomes power, and power attracts capital. For years, silver and gold were treated as static assets, symbols of wealth, hedges against inflation. But in this new world, they are active tools of influence, and the companies that control them are no longer invisible. They are central. This is the final warning for investors, entrepreneurs, and capital allocators. If you wait until the market fully understands what's happening in precious metal mining, you will be too late. The repricing has already begun. The capital rotation is now underway, and the companies once seen as irrelevant are about to become essential.